Is it good to consolidate debt into a mortgage? Many times my clients, they approach me and they're in this situation or this scenario where they're top heavy on debt and they're considering restructuring their mortgage so they can take care of some of this crippling debt. In this episode, we're going to go through all the ins and outs of what that looks like. In this episode, we'll discuss all the steps that you need to take in order to be prepared for a cash out refinance. Then we'll discuss home equity loans and home equity lines of credit as an alternative to refinancing your home. We'll also look at the benefits and risks of refinancing your home. All right, let's get to it. Okay, so let's talk about what a cash out refinance is. A cash out refinance is gonna be a loan that's gonna actually replace your current mortgage, completely replace it. It's gonna replace your current loan, but it's going to be for a value that's most likely going to be much higher than your current loan. So as an example, if you had a $200,000 mortgage and you're looking to roll out $50,000 worth of cash and you have $100,000 worth of equity in that home, you're going to replace that $100,000 mortgage with a $150,000 mortgage, and then you're going to roll out that cash to use it however you'd like to. Now, when you roll out that $50,000, there's going to be additional costs. First of all, you're going to have to deal with the interest rate. It could be a higher interest rate. It could be a lower interest rate. In today's market, it's probably going to be a higher interest rate, but then you also have to deal with closing costs. Now, sometimes you can roll those closing costs back into the new loan, but closing costs are usually significant in the thousands and sometimes tens of thousands of dollars. The first thing about these types of loans is that you need to know that you have to have a good credit score. I mean, really, you just have to have a mediocre credit score. Usually a 620 will get a cash out refinance done. In most cases, you can cash out up to 80% equity in your home. So again, back to the $200,000 mortgage that we were talking about, you can refinance up to 80% of the value of your home. So in the case of $200,000, you can refinance up to $160,000. Now do know that the closer you get to 80% of the value of the home, the higher interest rate, and the more difficult it becomes to get that type of cash out refinance. Now, as an example, somebody who has a ton of equity in their home and their home's almost paid off and they only want to cash out $30,000 to $50,000 of their equity, they're going to have a lot less hard of a time trying to get that transaction complete, as opposed to somebody who's got mediocre credit scores and then is trying to max out as much as they can possibly take from their home. So there is a loan program that's exception to the 80% rule. Your VA loans or your veteran loans will allow you to cash out up to 100% of the equity in your home. So I don't want to discount what it costs to actually perform one of these transactions. Even if you have a VA loan and you're cashing out 100% of the equity in your home, realize that you can go up to 100% equity, but you still have to pay closing costs on that transaction, and they can be significant. I had a specific client that actually had a home that they purchased in an up and coming area within the Dallas area. Purchased the home for $300,000. The home was jumped to $700,000 over the last 10 years. The client needed to pull out significant sums of money to keep their business afloat. However, their credit scores weren't good enough to pull out that money. And what's unfortunate is they maxed out their credit cards. They have all this money that's locked up in their home, hundreds of thousands of dollars, but they have no way to access it because they didn't have the credit scores to get there. Okay, when you're looking for a cash out refinance situation, I definitely recommend that the first thing that you do is make sure that you have the scores to qualify for a refinance before you start shopping around for lenders. But if you have qualifying scores, that 600 to 620 mid-mortgage score, it definitely makes sense to go to a couple of different lenders and have them compete for your business. Each lender can provide you a loan estimate, and you can present that loan estimate to a second lender and have them compete for your business. Most people that are doing a cash out refinance are trying to pay down their credit card debt. In other words, they've got their budget, they've got their overall expenses for the entire month, and there's more money that's going out than is coming in, or pretty close to that type of situation. At the end of the day, their disposable income is limited, and they're trying to better that situation. So just make sure that if you refinance your home, that you've actually lowered your overall monthly expenses. In some cases, people trade a bad deal for a worse deal. Okay, now if credit cards are your thing that you're trying to pay off, make sure that you target your credit cards that have the higher interest first. A lot of people will try to target the credit card that has the highest balance first, and that doesn't always make sense. You need to list out your credit cards and determine where the interest rates lie, and regardless of the amount of the balance, you need to chisel away at the highest interest first. Now, if you're in a situation where you have student loans that you're considering paying off, I recommend, depending upon the interest of the student loan, that you may consider not doing that. Most of the time, student loan interest is relatively low, usually 3 to 6.5%, relatively low in the scheme of things. So if you're deciding whether you're going to pay off your student loans, you're going to pay off credit card debt, you're probably going to always choose the credit card debt. Another thing that people will oftentimes try to refinance their house for and pull out cash is for medical debt. I always say that this is a terrible idea because medical debt doesn't carry interest. In other words, you may owe a medical facility for a procedure or you may have doctor bills, but those bills don't accumulate interest. The only time they accumulate interest is if you tried to pay for it with a credit card first, or you applied for a credit offer to help pay for those bills and then weren't able to make those payments. But in general, paying off medical debt doesn't make sense because you're trading no interest for interest. Now, there's two alternatives to a cash out refinance. One is going to be a home equity loan and one is going to be a home equity line of credit or a HELOC loan. The home equity loan is actually just going to be a second loan. It's going to be a second mortgage for a lump sum of money, and you're going to get that entire lump sum of money. But now you're going to have two mortgages. You're going to have your first, and then you're going to have your second for whatever you took out from your home. So it's where a cash out refinance replaces your original loan and put cash in your pocket. Your home equity loan will actually create a second loan that now you need to make a second payment on. Now, your home equity line of credit or your HELOC loan is wildly popular. People talk about these loans all the time. You'll see signs up for them. And actually, they're not too bad of deals, quite honestly. What I like about HELOCs is that they're going to issue you a line of credit, and it's there for you to use if you so choose. In other words, if you have $100,000 worth of equity available in your home, they're going to issue you a $100,000 line of credit. And when you take out portions of that $100,000, you pay interest on only the portions that you took out. And when you repay it back, you have that whole amount now available to you one more time. The home equity line of credit actually allows for flexibility. It works much like a credit card. And you're not taking out a big lump sum that you may or may not use. Now, just remember, both of these situations require that you have good credit, and they also have significant fees and closing costs. You're going to definitely want to check into both of those things. Before we get into the benefits and risk of refinancing your home, please like this video and subscribe to my channel. I'll be working hard to bring you a video each weekday over credit, lending, real estate, and other relevant personal finance topics. To begin with, in terms of benefits, when you refinance your mortgage, you're going to have fewer monthly payments that are on your budget. In other words, if you had 10 credit cards that you paid off, you no longer have 10 payments that you have to keep up with. In addition, when you pay off those 10 different credit cards, you're going to see a big spike in your credit score. One of the biggest areas within the credit scoring algorithm is going to be what's known as credit utilization. It makes up 30% of your credit score. And once you clear out your credit cards, you're going to see a big spike in score. You'll also get to take advantage of the mortgage interest deduction on your new loan. Okay, so now let's talk about some of those risks. The first thing is that if you had a mortgage, and let's say you had a 30-year mortgage and you paid 10 years of that mortgage, you only had 20 years left. Odds are that when you refinance your mortgage, you're probably going to take another 30 years. So you're going to pay longer on that mortgage, and you're going to accumulate a whole lot more interest over time. Another risk is that in order to successfully complete a cash out refinance and consolidate your debt into your mortgage, you're going to have decent credit. There's nothing more frustrating than having a ton of equity in your home, a ton of money just there to help you in your financial situation, but not being able to access it. Now remember that you're actually using your home as collateral for this money that you're pulling out of your home. And that could potentially put you in a situation where you can't pay your bills in the future because you've taken on more than you can afford, and potentially a foreclosure could come into play or a bankruptcy could come into play. Another risk is that you pull out money from your home and then you find later on that you're in the exact same situation that you were before you took the money out in your home. So a lot of people try to save their situation. And the way that they do that is they try to find money to infuse their current situation and then hopefully never have to deal with that situation again. But in practice, that's usually not the way it works. If someone's taking out money from their home in a big way and they've maxed out their credit cards, what usually ends up happening is they end up going back to that same place where they've maxed out their credit cards one more time. This is especially true for business owners when they're trying to save their business. Business owners are very loyal when it comes to their business. They're willing to do whatever it takes to keep that business afloat, even if that means taking money from their home or maxing out their credit cards. So if they've decided that, hey, I've maxed out all my credit cards for my business, I'm going to take out money from my home to pay off those credit cards that I've maxed out for my business, a lot of times they end up doing the same thing over again.